Have you ever dreamed of making $30,000 a month with just $50 a week? It sounds too good to be true, right? But what if I told you there's a method that could make this dream a reality? In this video, I will show you the dividend growth investing method, a powerful strategy that leverages compounding returns and consistent dividend growth. I will show you a carefully created portfolio that has the potential to pay over $30,000 in monthly income. But first, let's understand DGI and how it works. Dividend growth investing, or DGI, is a strategy that combines regular dividend payments with the power of reinvested earnings to grow your wealth. Simply put, it involves buying shares in companies on a regular basis that not only pay dividends regularly, but also increase their dividend payments over time. This method helps investors benefit from both a steady income and rising stock prices, creating a strong path to financial independence. One main advantage of DGI is the steady income it provides. Unlike risky investments that depend on market timing or price increases, DGI offers predictable cash flow. This is great for those wanting a reliable passive income. Dividends are usually paid every 3 months, providing regular income that can be reinvested to buy more shares. This reinvestment creates a compounding effect, where reinvested dividends buy additional shares that generate even more dividends, accelerating the growth of your investment. Another big benefit of DGI is the growth of your portfolio. Companies that consistently raise their dividends are generally financially stable and have strong earnings growth. By investing in these companies, you get a steady income and enjoy stock price appreciation. Historical data shows that dividend-paying stocks have performed better than non-dividend-paying stocks over the years, with higher total returns and lower volatility. This makes DGI a more stable and less risky investment strategy. Take Coca-Cola and Johnson & Johnson, for instance. These giants have been boosting their dividends for decades. Investing in them is like betting on a winning horse: reliable, steady, and highly rewarding. The beauty of DGI is in its simplicity and effectiveness. It's not about quick, speculative gains, but about gradually and consistently building wealth over time. Unlike short-term trading, which relies on market timing and quick gains, DGI is about allowing your investments to grow steadily over the years. This means understanding that the journey to significant returns is gradual and resisting the urge to react impulsively to market volatility. Historically, markets have shown resilience and a tendency to recover from downturns. By holding on to quality dividend stocks through various market cycles, investors can benefit from both the consistent income from dividends and the appreciation of the stock value. Consider the success stories of seasoned DGI investors. Take, for example, Warren Buffett's $1 billion in Coca-Cola in the late 1980s has grown exponentially to over $20 billion. By holding on to the stock and benefiting from its regular dividend increases, Buffett has seen substantial returns. This kind of success is not an overnight phenomenon, but the result of years of patient investing. Such examples highlight the importance of maintaining a long-term vision and trusting the process. In the end, I will show you a portfolio that might not be worth billions, but can pay over $30,000 in monthly dividends. Now that you know what this strategy is all about, the next step is setting up your DGI portfolio. Setting up a DGI portfolio requires a thoughtful approach to selecting stocks that will not only pay dividends but also have a strong potential for growth. The first step in this process is choosing the right dividend stocks. It's essential to focus on companies with a history of paying and increasing their dividends consistently. The best places to look for it are in the lists of dividend aristocrats or dividend kings, which have consistently increased dividends for 25 and 50 years straight, respectively. When evaluating potential dividend stocks, key metrics to consider include dividend yield, payout ratio, and dividend growth rate. The dividend yield tells you how much a company pays out in dividends each year relative to its stock price. A higher yield can be more attractive, but it's important to make sure that the yield is not above 10%. This can lead to what we call a dividend trap. More on that later. The payout ratio, which is the percentage of earnings paid out as dividends, helps in this assessment. A lower payout ratio suggests that the company retains enough earnings to invest in growth and can maintain or increase dividends during economic downturns. Finally, the dividend growth rate indicates how much the dividend has increased over time, reflecting the company's ability to grow its earnings. Diversification is another critical aspect of setting up a DGI portfolio. By spreading investments across different sectors and industries, you can reduce the risk associated with any single company or market segment. Diversification ensures that the portfolio can withstand sector-specific downturns and continue to generate income. It's about balancing the portfolio to include a mix of high-yielding stocks, those with high dividend growth rates, and some with stable but moderate returns. One important guideline in selecting dividend stocks is to avoid dividend traps, which are stocks with unusually high yields that might not be sustainable. These high yields can be tempting, but they often indicate underlying issues with the company's financial health. Companies that offer excessively high yields might be doing so because their stock prices have dropped significantly due to poor performance or financial distress. It's crucial to research and understand the reasons behind a high yield to avoid investing in companies that may cut dividends in the future. Let's consider a practical example of building a DGI portfolio with specific stock selections. I will include a variety of companies known for their strong dividend performance and growth potential. My portfolio will feature ProShares S&P 500 Dividend Aristocrats ETF, Jefferies Financial Group, Lennar Corporation, American Tower Corporation, and Cintas Corporation. The question is, what do these stocks bring to the table? NOBL is an excellent foundation for a DGI portfolio. This ETF includes companies that have increased their dividends for at least 25 consecutive years. It offers diversification and exposure to high-quality dividend stocks across various sectors. JEF is selected for its robust financial health and consistent dividend growth. LEN, a leading home builder, provides exposure to the real estate sector and benefits from an ongoing demand for housing. AMT, a prominent player in the telecommunications infrastructure space, offers stable dividends and growth potential driven by the increasing demand for data and communication services. Lastly, Cintas Corporation, a provider of business services, has a solid track record of dividend increases and a strong market position. The investing metrics for each of these stocks look something like this. If you combine all these into a portfolio, your portfolio average current dividend yield will be 2.10%, which provides a solid income base. The average dividend growth will be 20.26%, showcasing the potential for increasing income over time. Additionally, the average share price appreciation over the same period of the portfolio is 12.87%, indicating that the portfolio not only generates income but also grows in value. The question now is, can this portfolio pay over $30,000 in monthly dividends with only a $50 investment per week? Let's break it down. If you invest $50 a week, or $200 a month, or $2,400 a year in this portfolio, here's what it would look like. After 5 years, the portfolio will be valued at $16,331. After 10 years, this disciplined approach could result in a portfolio worth around $51,510, and your weekly combined investment totals $24,000. This significant growth is fueled by the reinvestment of dividends and the compounding effect, showing how small, consistent investments can lead to substantial wealth over time. As the portfolio grows, the dividends increase both in amount and frequency, further boosting the investment's value. Projecting further into the future, the numbers become even more impressive. After 20 years, the portfolio could be worth approximately $351,501 from a total investment of $48,000. So your investment amount has doubled, but your portfolio value has increased by 600%. And it gets even better from here. This is where the power of long-term with DGI investing truly shines. By sticking to the strategy and reinvesting dividends consistently, the growth becomes exponential. The dividends themselves become a significant source of income. For instance, after 30 years, the portfolio value is projected to reach $3,396,925, paying annual dividends of about $433,634, translating to a monthly dividend income of roughly $36,470. The total value added by the investment over 30 years includes $1,658,962 from capital appreciation and $1,665,963 from reinvested dividends. Want to know how much a portfolio of the 3 absolute best ETFs can pay from $100,000 and set you up for life? Click the video on the screen.